Dave Ramsey hates reverse mortgages. Who knew? So we're going to talk about that here today with an article he had written. Actually, it's not even dated. So welcome to Heritage Wealth Planning YouTube channel, my friends, the place where you come to learn all about financial planning, retirement planning, taxes, investments, you name it. We're going to talk about it here because I got all the answers. I don't. Trust me, what I've learned from clients and people on my YouTube channel, just clients in my 20 odd years in this business, has been enough to write a book. So I don't have all the answers. You don't have all the answers. Combined, I bet we can come up with a pretty good idea of the best way forward. And one of the ways is a reverse mortgage. Dave Ramsey just bullocks this remarkably, actually, and I want to go over it because I have to chuckle. So let's dive right into it. Yeah, I got a little bit of a different background. I'm all by myself here in my house. All the kids are out. My wife's out of the house, and I'm going to get outside. At least I have a nice little visual behind me of the green trees of Georgia. Man, seeing that green back there, oh, I love it. All right, so let's dive right into this now. So here's old Dave smiling. I know Dave's got a lot of fans, and I know a lot of people get ticked off when anyone comments negatively on it. I get that. In this case, he's just simply wrong, and it's not even wrong. The words he uses, it's infantile, and I don't understand. Again, as a Christian, we all got to watch our pride. Trust me, I'm looking at myself here too, but I just think Dave falls. He's just got too much pride in some regard here to at least think about things, especially when it comes to this. So it's too bad because I do think he does great work. Paying off debt is a wonderful thing. Absolutely. Dave has been helpful to me in my life in that regard to pay off debt. All right. So here's how does reverse mortgage work? Chip on Twitter asks, says his grandparents are looking into reverse mortgage. What is this and what does Dave think about it? And Dave says a reverse mortgage, if you think about it, is exactly the reverse of a mortgage. What do you do with a mortgage? With a mortgage, you pay payments, and every month you pay down principal. With a reverse mortgage, you don't pay payments, you receive them. Every month you go deeper into debt. You start out not so much in debt, but every month you are borrowing a little bit more on your home. I do not recommend them under any circumstances. Heaven forbid you take a reverse mortgage. The reverse mortgage is loaded with gotchas. Okay. The interest rates that they're calculated are horrendously bad. They're not a good product. The concept is not extremely bad, except for the fact we've got old people who've worked their whole lives off to get completely out of debt. And now what are they going to do? Some goober in the financial planning field tries to talk them back into debt. That's enough to make you mad right there. Aside from that, the concept of every month you're going to get a little check and every month you're going to end up a little deeper in debt on your home is probably not the end of the world if someone is completely broke. But when you add in the fact these things have rip-off fees, like you wouldn't believe, interest rates are horrible. And I guess because it's largely the elderly who are doing it, it's the fraud rate on these things is unbelievable. I just tell you to stay away from them. And so, all right, that's fine. All right, in of itself, whatever. But here's Dave's solution. All right, so, grandma's sitting there, Dave. She's starving to death. She got no money. The house is paid for and she doesn't want to move. What does she do? And old Dave says there are two options. None of which are good, but she's broke. When you're broke, you don't have a lot of good options. One of the options is a bad option with reverse mortgage. That's a bad option, as Dave has said. Another option is not as bad an option. It's very painful to sell the home and buy something less expensive, freeing up some cash to eat with. That's a possibility. Sometimes folks have to do that because they've not saved money. And he talks about don't be going broke. Okay. What are the other options? I don't like this option either, but before I did a reverse mortgage, I would take on a full-on mortgage. Just borrow as much as you possibly can borrow against the house. Put that $100,000 or whatever in an investment, pay the payments out of the investment, eat out the investment, and when the money's gone, sell the house. When the reverse mortgage runs all the way up, they're going to stop sending checks too. There's an end to this. If grandma outlives the size of the equity in her home, either way, she's going to have a problem if she tries to stay in this house. The house is going to leave. On a reverse mortgage, that's what happens. When it runs up to a certain point and they pass away, the debt is repaid. On some of the old reverse mortgage, they were really bad. They were set up on actual okay, I see. That was a complete ripoff. And no matter when you die, the house went to the bank. That's all right. Well, that's not okay. So he's using the old reverse mortgages and saying there are some bad people who've done bad things. Reverse mortgages are bad. And that's just that's a straw man. I know a reverse mortgage that did bad, thus all reverse mortgages are bad. That's silly. All right, so I want to talk about a couple of things here because this actually, again, it annoys me. All right. So there are two options, one of which is to sell the house. Well, grandma doesn't want to sell the house. The other option is to take a mortgage. All right. Does Dave have any concept of the term debt to income ratio, DTI? If grandma is living on $1,000 a month of Social Security, and I even say that's probably high, but let's just say it's $1,000 a month of Social Security. That's $12,000 a year. If she were to take a $100,000 mortgage, that's going to be for simplicity now, that's about a $500 to $600 a month payment. If she's got $1,000 a month of Social Security, and the mortgage costs $600 a month to pay back, and that's over 30 years now, mind you. Now, banks can't discriminate. They can't say grandma's 88, she can't take a 30-year mortgage. They can't, so it's going to be a 30-year mortgage if she's trying to increase her cash flow. Guess what, friends? No bank is going to loan her the money because her debt-to-income ratio is 60%. She is not getting a mortgage. I cannot stress this enough. It is not going to happen, Dave. She will not get a mortgage if she doesn't have the cash flow to eat because of this thing called debt to income ratio. There is no bank that's going to loan grandma a $500 or $600 a month, 30-year mortgage amortized over 360 payments that cost $500 to $600 a month on principal and interest. No one's going to do it because your debt to income ratio is so high. For the love of the good Lord, get that through your head. If your debt to income ratio is above a certain percentage, 35, it used to be 28 to 36. And now who knows what it is now, but given the bank went through that insane crisis of 2008, we all bailed them out. And now don't even get me started on that. The banks aren't going to loan people with a debt to income ratio above 50%. It's not going to happen because they can't qualify for the loan. They can't. So this one right here is completely off the table. And the idea that Dave doesn't get that, it frustrates me to no end because there are people out there saying right now, I can always get a mortgage. No, you can't, Grandma. And if you're the son of or the grandson of old Grandma, no, she can't unless there's a co-signer for the note. And who's going to co-sign? The son? Okay, now Grandma can't pay it because the debt to income ratio is 50 to 60%. Why can't she pay it? Because she doesn't have enough cash flow to qualify to begin with. Guess who it falls back on? It falls back on you, son or daughter. And guess what? The bank's going to come crawling because you are a co-signer of the note. And they're going to send collections after you like you wouldn't believe. And ultimately, because Grandma can't pay, they're going to put a foreclosure notice on it. Wow, now you have no house. Hey, but Dave hated reverse mortgages. All right, secondly, pay the payments out of the, okay. The idea that this, if I were to say to somebody, borrow against your house and invest in the market, you can't do that. You can't. I mean, that's where the reverse mortgages got, some of these guys, they did it wrong because they said, borrow against the reverse mortgage and put in the market because the market goes up 8%. Oh, who says that? Oh, Dave says that. Dave says you get 12% in an aggressive growth fund, 10% in a whatever. I don't even know what he calls it. Who says that stuff? So Dave's sitting there thinking, man, you can take 7% a year out of your portfolio each and every year without worrying about running out of money. Why? Because the markets give us 10% a year. And if you got an aggressive fund, you can get 12%. It's insane. If any investment advisor says that, they should lose their stupid license because it's insane. If that were true, then everybody in the world should have 100% completely leveraged. There should be no equity in their home because the cost to borrow against your home is like 4%, we'll just say, or 5%. I don't even care. Where theoretically, the rate of return you can get in the markets are double that. It's insane. It's insane. No one's going to sit there and say, borrow against your house and use that money to invest it to pull cash off. That's insane. I can't believe this. And then lastly, he says, when the reverse mortgage runs all the way up, they're going to stop sending you checks. No, they don't. I hate to get so animated on this. Actually, I don't because it ticks me off. They do not stop sending you checks. There's something called a 10-year payment. Now, I'm going to go to you right here. Let's go to my man, Wade Pfau, who's got a PhD and all kinds of stuff. He's a professor. This guy knows more in his pinky than Dave knows all around. Yes, I get it. You love Dave and you're mad at me now and you're probably going to unsubscribe. You got to do what you got to do. All right, so let's go to his resources here. For Wade, and we'll show you how it works. We're going to go to his, I got to move my big fat mug out of the way. This just infuriates me. Calculator right there. So we go to he needs to make that a little bit more conspicuous. All right, so we're going to go to retirementresearcher.com. We're going to open up go to resources and retirement mortgage calculator. This is a line of credit. We're going to say you got a $300,000 home. Oops. Yeah, right there. 300,000. Oops. Yeah, there we go. Okay, good. We're going to say we got a $300,000 home, and we're going to say you don't have any mortgage on it simply because we are talking about grandma and what is his name? Chad. Yeah, Chad said grandma has her home paid for. So there's our 3.28% 10-year LIBOR swap. That's horrendous. That's a ripoff rate, Dave? No, it's not. That's absolutely not horrendous. There's a lender's margin of 2.25. So the total cost on this interest rate now is what's that? 5.5. Okay, that's not horrendous, Dave. That's not. Now you do have to pay a monthly insurance premium, and if you click on what that is, Old Wayla sells us used to support the government's insurance fund that provides guarantees to both the borrower, that grandma, and the lender. For all the loans issued at the present, it remains permanently fixed at 0.5%. So the all-in cost on this is 6%. That's not horrendously high. It's absolutely not horrendously high. And I hate to say it, but there is potential tax deduction too when the kids inherit the property and they sell the house or they pay it off. I'm not even going to get into that because, frankly, I don't care. But that's not horrendously high. That's not credit card returns, rates. It's just not. What's a 30-year? I don't even know what the 30-year is doing right now. But the 10-year bond right now, 10-year Treasury is paying, let's see here. Oops. The 10-year Treasury is at 3.25. All right. So the swap, that's the 10-year, that's a 10-year right there. 3.28. The 10-year Treasury is at 3.25. Okay, that's not horrific. You got a lender's margin of 2.25. That's no different than you're going to get for a typical mortgage, except you're going to get this mortgage insurance premium. Why do you get the mortgage insurance premium? So that way the lender, when you borrow, if the home equity goes, the amount that you owe goes above the value of the home, the lender will be paid in full without having to put old sweet grandma out. That's how it works. That's what you're paying for a mortgage insurance. That's literally an insurance. If the value of the home goes below the amount I owe, the bank has a guarantee from the mortgage insurance premium, the pool they use to money to guarantee it, that the lender will get paid in whole. That's how that works. Okay, is it more expensive than a typical mortgage? Yes, because you have that. But you also have the guarantee that you don't have to worry about being underwater in your home. It doesn't work like that. All right, so let's go to say grandma is, we'll say she's sweet grandma. She's 85 years old and she's eating cat food. All right, we're going to get rid of it. We're going to say it's origination fee. That's fine. I would argue against origination fee. In fact, what my man Wade says is you can actually negotiate a lower to a zero origination fee. Oops. We're going to say the maximum possible origination fee is $2,500. All right, so $2,500. Again, that's horrendous. That's a ripoff. Yeah, bull crap, Dave. We're going to say origination fee of zero. And then what we'll do is we even raise the lender's margin because they're going to get paid some way. There's no getting around that. So we're going to say we're going to raise the margin so have a no origination fee. We're going to raise the margin to 3% for the. And look, I'm just pulling this number. I don't know how much more the lender would charge you or less. I don't know. But now we got a 6.5, basically 6.75% home equity line of credit, reverse mortgage line of credit that the lender is going to charge grandma. Now she has no origination fee. Her mortgage insurance is $600. Other closing costs $2,500. Her total closing costs are $3,100. All right. That's not too shabby. Oh, I got to do a $300,000 loan. That's what I meant to say. So here you go. $300,000 loan. And yeah, the origination fee is depending on the price of the house. There's still no mortgage insurance, no origination fee. The initial mortgage insurance is $6,000 because it's 2% of the appraised value, not the assessed value. We're going to roll that into the closing cost. We're going to roll the cost of appraisal and the titling insurance, which drives you crazy. So the upfront costs are $8,500. We're going to finance all that. We're going to put it all in the loan. All right. And so now how much does grandma have? She has 54% is her principal limit factor. All right, which means she can borrow $153,500 in totality. And if we take that as a monthly 10-year payment, 10-year means every single month as long as she's breathing and in that house. As long as she's in the house, she's going to get $1,300 a month, $1,353. That does not stop. It doesn't matter what happens to. She got $300,000 appraised value. What happens to the home equity conversion mortgage amount? If that goes above the $300,000 and the $300,000 drop, none of it matters. This will stay for her entire term, for her entire tenure, which means until she is dead. There's no getting around that, Dave. It doesn't change. This will not go away. She will not be put out unless she refuses to pay her property taxes, not her homeowner's insurance, her property taxes. If she doesn't pay her property taxes, she will be put out. That is a fact. But that, frankly, has got nothing to do with a reverse mortgage. It has to do with any mortgage, a home equity line of credit. Hey, mortgage, your first mortgage, like Dave's talking about too. All right, so that's enough of this rant. It just drives me up the wall. And then it goes right into this thing too on CNBC. Women are losing sleep over their retirement savings because they're worried about long-term care costs. So let's bring this up a little bit. Could these things go hand in hand? Because women are saying, because women typically take care of mom. Moms are the ones who survive. Women just are the ones who survive, are more maternal. Oh my goodness, that's so sexist to say. No, it's not. Women are more maternal. Or is it paternal? Maternal, yeah. Women are more maternal, so you see a whole heck of a lot more women take care of mom in assisted living, nursing home, or as stay-at-home moms or stay-at-home care, absolutely, than men. It's just a fact, and I care if you don't like it. Doesn't matter. It's a fact. So these are what people are losing sleep over the retirement savings fear. 7 of 10 women are very concerned about having enough money to cover their long-term care expenses, according to Nationwide. More than 60% of high-income adults over 50 have no idea what their long-term care costs will be. Too often they fail to discuss the financial impact of providing care. What could it do? When it comes to retirement savings, living too long can be a blessing or a curse. For women who tend to outlive men, mostly, spending years caring for family members is a major cause of anxiety. The Nationwide, they did 1,007 poll of 1,007 adults. And they said 71% said they are worried about having enough money to pay for long-term care costs. The word was especially keen among caregivers. 3 of 4 said they were concerned about keeping up with long-term care costs. Right. The whole point about this is 2 things. Again, if you're worried about long-term care costs, I don't know how you can not look at a reverse mortgage as a stopgap in there. Not even a stopgap, a permanent solution for that, for sure. I just showed you. Grandma can get $1,300 a month. That's a fact. Will that cover in-home health care? No. Will it cover an assisted living facility? Absolutely not. Will it cover, going to a continuing care retirement community? Absolutely not. But it will cover something. That's a fact. And that's grandma with a $300,000 note. And she's 85 years, how old? Yeah, she's 85 years old right now. That will go a long way to providing some of the resources there to care. That's just a fact. Now, on top of that, and here's the problem, it's no secret that paying for long-term care is a costly endeavor. The average national median cost of bringing home health aid was $49,000. The median cost of bringing, so that's bad statistics because they're saying the median cost of bringing in home health aid. All right, so that's only the people who actually bring in the home health aid. That's not everybody. So if you have a population of 100 and only 20 people bring in home health aid, the median cost for those 20 people is roughly $50,000 a year. Okay, well, that's interesting because how about those other 80 who did not bring it in? Again, it's preying on your fears. And so a semi-private nursing home is $85,000. Yes, that's the average. That's the median, 50% above, 50% below of people who use a nursing home. What if you don't use a nursing home? You're not even factored in this assumption. All right, so 2 things going on here, and then I'll stop. Stop the worry about long-term care. I'm not saying don't have a plan. I am absolutely saying have a plan. But if it's keeping you awake at night, you know for a fact reverse mortgages go a long way to provide this. Let's just say the median cost is $50,000, and grandma, we already talked about, she can get $1,400 a month times 12. That's going to give her a third of what she needs for the median cost now. Now remember, this is $300,000 home, so that means she's in a lower cost of living place like Alabama. So we're going to say the median is a whole lot. The value that she has for her home only being $300,000 is the cost for an in-home health aid will be a heck of a lot lower than the median because the median is half above, half below. So let's just say it's $35,000 a year. So she's already halfway there just on her reverse mortgage alone. Without question, she's already halfway there. Don't overlook the opportunity for reverse mortgages. 1, that is a wonderful, wonderful resource for you to consider when it comes to this. Do not lose sleep over your long-term care costs because you're missing the boat here. Genworth, Nationwide, they are insurance companies. Do they have an incentive to get you worried about this so you can buy their insurance products? Absolutely, they do, and they do a great job. Don't let it make you lose sleep at night, because the facts are the median long-term care cost is not relevant to the population as a whole. The median cost is only for the people who are in the demographic, that 20% of the people who actually need long-term care. That's it. The other 80%, and again, I don't know the exact specifics on the amount, but it's pretty doggone close to that, are not even included in this number. If you factor in 100 people, what's the median cost of long-term care for those 100 people who use long-term care needs or don't? That's a completely different number. Oh, and we have studies that have done that. My own YouTube channel, I show you some of the studies as well. So anyway, hope this helps. Frustrates me to no end, but if you have any questions, thoughts, concerns, love to hear them. Thumbs up, comment down below, and don't forget to subscribe. We'll see you next time. Thanks, guys.